players are here, so why don't we get started? I'd like to welcome everyone to the Annual Economic and Revenue Consensus Forecasting Conference. My name is Mary Beth LeBate. I'm the newly appointed Director of the Budget. Joining me today on this forecasting panel are, from my right, Senator John DeFrancisco, Chair of the Senate Finance Committee. To my left, Assemblyman Herman Farrell, Chairman of the Assembly Ways and Means Committee. Senator Valesky, IDC Deputy Conference Leader and member of the Senate Finance Committee. Senator Martin DeLon, Senate Finance Committee. Assemblyman Robert Oakes, Ranking Member of the Assembly Ways and Means Committee. And Robert Ward, Deputy Controller. I'm pleased to be presiding over the panel for the first time. Today's conference represents the first step in what we all hope will be a collaborative and collegial march towards a state budget that every New Yorker can be proud of. Each member of this panel will have an opportunity to provide brief opening remarks. Afterwards, we'll hear testimony from a cross-section of experts who will offer their perspectives on the current economic and revenue situation. Let's start with some good news. As hard as it may be to believe, we're heading towards the beginning of the 7th year of this nation's recovery from the Great Recession. And there are good reasons to feel optimistic. Energy prices are at their lowest point since early 2009, a windfall for all Americans on any range in the income spectrum. The U.S. economy saw 2 quarters of growth above 4% in 2014. Indeed, last year alone, the nation's private sector created 2.6 million jobs, the most since the height of the dot-com bubble of the late 1990s. And I'm happy to be able to say that we did it without the bubble. All of us can be proud that of the 9.4 million private sector jobs created between 2010 and 2014, over 500,000 were created here in New York. The national unemployment rate fell to 5.7% in January, the lowest since 2008, while the state unemployment rate is at its lowest level since September 2008. New York's recent job gains have been broad-based and no longer concentrated in the low-wage sectors that characterized the earlier stage of recovery. The state is creating jobs in high-skill, high-wage areas, making New York well-positioned to compete with anyone, anywhere in the global arena. But all of these appealing statistics provide no excuse to rest on our laurels. Not every New Yorker has been able to share in our relative prosperity. We also know that economies in New York State are highly regionalized, with many areas still working hard to recover the jobs that were lost during the recession. We've come a long way, and there's more to be done. So while we have a lot to feel good about, we must remind ourselves that significant risks remain, a fact that even the weather won't let us forget. It is looking like our frigid weather will be shaving a significant amount of growth off the economy's first quarter performance. I look to our panel of experts to offer some guidance on that score. Weather aside, and despite a national labor market that is in its best position since the start of the recovery, the most recent data suggests a substantial deceleration from the middle of last year. Bob Megna promised me that wouldn't happen when he convinced me to take this job, but it seems to be happening. The global economy is weak, and it is unclear how encouraged we should be by a recent spate of green shoots, another area we look to our panel of experts to comment on. I think we can all agree we've been disappointed before. It is tempting to say that with the recent weakening of the euro, maybe this time is different. But the flip side of a weaker euro is a stronger dollar, and again, we look to the panel to provide us an assessment. For New York, one of the greatest risks lies with the future action of the Federal Reserve. I think all of our economic staffs agree that the central bank is likely to start raising interest rates before the year is out. Again, we'll ask the panel for some guidance there. I don't think anyone in this room needs to be reminded that as the nation's financial capital, financial market volatility poses a particularly large degree of uncertainty for New York. Recent events have demonstrated how sensitive markets can be to shifting expectations surrounding Federal Reserve policy. and the resulting market gyrations are likely to have a larger impact on the state economy than on the nation as a whole. Which brings us to the topic of Wall Street. Last year was not a good year for the financial sector. Despite double-digit equity market growth and IPO growth of 60%, it appears that we are seeing the weakest bonus season in 3 years. Although Wall Street has always been a source of high volatility, we have to recognize that Wall Street is playing under a new set of rules and may never again be the growth engine of state revenue it once was. Wall Street firms have been altering their executive compensation practices in response to regulations that are still being written under Dodd-Frank. We've observed dramatic reductions in the cash portion of bonuses in favor of equity grants, with large portions of compensation being deferred and subject to clawback. Moreover, deferral patterns have changed from year to year. These changes, while necessary, have challenged our forecasting models in ways that we are still trying to sort out. Thanks to the greater diversification of the state economy, and I might add, prudent budgeting on all of our parts, we are weathering the weakness in bonus payments without too much difficulty. That said, this is exactly the right forum for acknowledging the added uncertainty to our income and revenue projections, and we must resolve to plan accordingly. Nevertheless, again, there is much positive news. The state labor market remains strong and well-balanced. New York remains a tourist mecca, drawing visitors from all over the world to our state's unique urban and natural attractions. The state's business service industry is serving a growing global market, and our real estate and construction sectors are leading the nation. So while we're on a great path, our optimism must be tempered with caution. All too soon, the current environment of low interest rates and easy access to capital will come to an end. Historically, whenever the Federal Reserve shifts from an expansionary to a contractionary policy stance, the impact on financial markets and consequently New York's revenue base is unfavorable. Consequently, it's critical that we look ahead and prepare ourselves for that day. So it is against this backdrop of economic uncertainty that we embark upon the revenue consensus process. It is important to note that while there are differences in our forecasts, at a fundamental level, there is broad agreement that New York faces substantial risks given the nature of its revenue base. We will need to take the type of responsible, necessary actions proposed in the executive budget on both the revenue and the spending side to strengthen New York's fiscal position and at the same time provide the tax relief, particularly from the state's high property taxes, that middle-class New Yorkers so richly need and deserved. For 4 years, we have worked together to enact an on-time, fiscally responsible budget that embraces the principles that state spending must grow more slowly than the overall economy. With the establishment of the 2% spending benchmark, the unsustainable trends of yesteryear have been reversed, and we are seeing measurable improvements in the state's financial position. By controlling and managing spending growth, we have reduced the need to engage in overly aggressive revenue projections. All parties deserve credit for responsible budget making, and I thank you all for your cooperation. Each of the forecasts before us today represents a good faith contribution to the consensus process. Looking ahead, I know we're all committed to meeting the statutory March 1 deadline for a consensus revenue agreement. Revenue consensus is an important component of achieving our shared goal of a timely and responsible enacted budget. And at this point, I'd like to offer the other members of the panel an opportunity to make their opening remarks.
Thank you. I think what's really noteworthy here is the fact that we passed a Budget Reform Act a few years ago, and we used to routinely not comply with a bill that we actually passed. Over the last 4 years, I think in no small part due to adherence to that Budget Reform Act, today is part of that adherence. Having this meeting in time to come up with a consensus is extremely important, and I'm glad we're on time again. I'm glad we got good experts to give us some guidance. As a frequent watcher of CNBC, I usually have no clue of what the speakers are talking about, and when I do, I can acknowledge that with the economists, usually there's three with three different opinions all going in different directions. So I understand that. That's why we've got so many experts today. But fortunately, in the 3 years that I've been here before this year, there's been a relatively close agreement on what all of you have to say, which makes our job a lot easier. So I welcome all of you, and I look forward to a fourth on-time budget. And I just want to make an observation that I've been chairman for our fifth on-time budget in a row. I've been chairman of the Finance Committee for 4 years. I don't think there's any connection to that, but I'll remain. Okay, but thank you very much. I look forward to hearing what you have to say.
Oh, thank you. I am pleased to be here today. Anything to get out of that basement. The Ways and Means Committee staff forecasts an acceleration in the U.S. economic growth and a steady improvement in the state's employment and income for this year and next year. As this forecast is not without risk, however, I look forward to hearing not only the panel's thoughts on the economic outlook for the state and the nation, but also your views on the risks that we face here at home and abroad. The independent analysis you share with us today will provide a solid foundation for us as we discuss and debate various aspects of this budget. And I thank you for being here today, and I look forward to hearing about your comments. Thank you.
Thank you, Director Labate. I want to join my legislative colleague, Senator DeFrancisco, Assemblyman Farrell, who jointly will conclude tomorrow the public hearing review process of the state budget proposal. So we continue to meet the markers to potentially lead to that fifth on-time budget. Let me just suggest from my perspective as Deputy Leader of the Independent Democratic Conference that I and the members of the conference look forward to once again having a partnership role with the Senate Republican Conference in meeting these benchmarks, in enacting a fifth on-time budget that maintains the fiscal responsibility that we have seen under the governor's leadership these past 4 years, and I'm confident that in that spirit of cooperation that we will indeed be successful in our efforts. Thank you.
Yes, thank you. It's my pleasure to be here, as well as my colleagues have mentioned. We are in the midst of a process that, in adhering to it, it does feel a bit compressed, though, as we've run from budget hearing and have that continuing on while we're here for this. But this is always enlightening for us. You know, we have some of our people who crunch the numbers and do our best, and from that we're a bit less optimistic than the Assembly majority in how some of the revenues might come in. Actually, the governor in his 30-day amendments brought some of his expectations on personal income tax growth closer to where we are, but in essence we're all in the same ballpark. There aren't varying or widely divergent views, and so I think that's helpful as from our perspective on this side of the table, and hopefully in listening to you today and whatever we will have either our perspectives confirmed or else push us perhaps in a little bit different niche or direction, but always appreciate the opportunity to hear your professional perspectives.
Good afternoon. I'm State Senator Martin Malave Delan, 18th Senate District in Brooklyn, and I'm here representing the Democratic Conference and Ranking Member Senator Liz Krueger, and I look forward to listening to the distinguished panel, and we too look forward to an on-time budget. Happy to be part of the process. Thank you.
Thank you. Mr. Ward?
And on behalf of Comptroller DiNapoli, I think the remarks that have been made about the progress the state has made economically and budgetarily, the need to continue moving ahead and to look realistically at the risks that are out there, were all very well said, and looking forward to the insights from our experts here, and we thank you for your time being with us.
And with that, let's hear from the people who are here to hear. We'll start out, I know why don't we start out with Ted, and we'll just move down the road.
Okay, great. So is that turned on? We hear that? It is? We're good? Okay, wonderful. Ken Matheny with Macroeconomic Advisors. Thanks for letting us participate in this. I'm going to focus my comments on the U.S. macroeconomy, so I won't have much to say about New York State, for example, although I'm sure some of what I say will maybe have some ramifications for the state. But I do want to underscore before I dive in and go through some of the slides briefly here that we've prepared, that some of the comments I've heard in the last few minutes I would just underscore. A lot of sensible comments. The outlook for the U.S. is cautiously optimistic, I would say, in our terms, but there are risks and there are uncertainties. One in particular that was mentioned that I want to underscore, and that is how markets might respond when the Fed does begin to raise interest rates. I don't think there's much uncertainty that the Fed will be tightening fairly soon, later this year. Maybe in September is the most likely date at the moment. But there is certainly a question about how will markets respond as that tightening program gets underway. So that's just one of a number of risks. If there's time at the end, I may highlight a few more. All right, so let me dive in. Turn right to slide 2, entitled the MA Macro Agenda. When you think about the U.S., it's hard not to think about us in a global context. There are a number of global pressures and themes that bear on the forecast. Two that I will just highlight at the outset is what's happening overseas in terms of real growth, concerns about growth, particularly in Europe and maybe in Japan to some extent, and some of the international economic and geopolitical tensions that are reflected in financial markets here. One of those is the rapid increase in the value of the dollar on foreign exchange markets. And the second, and not wholly unrelated, is the sharp decline in energy prices that we've seen since last year. And those are having major impacts on the U.S. economy, indeed the global economy today, and will continue to have impacts on the forecast. We'll draw some of that out in a minute. But generally, our forecast is one of moderately above trend growth. And by that, we mean GDP growth for the U.S. This is in real terms after adjusting for inflation on the order of about 3% or a little bit less over the next few years. And that's enough to continue to put downward pressure on the unemployment rate. We've fallen something like 4 percentage points coming out of the recession, or the Great Recession. We think the unemployment rate at the national level is likely to fall down into almost 5%. And I'd have to say, if anything, the balance of risks on that are to the downside. I think it's more likely we'll see unemployment below 5 than a year and a half, 2 years from now, we'll see it, say, at 6 or 6.5, something higher than where we are today. So strong, moderately strong growth, continued decline in unemployment. Key assumptions or factors in the forecast are we assume that oil prices and energy prices generally will rebound, but slowly. We won't get anywhere back over the next couple of years to the sorts of oil and gasoline prices that we saw, say, 9 to 12 months ago. We also assume that the dollar will decline going forward. We think it's overshot a little bit on the upside, and as the dollar depreciates, that's going to have some impact on inflation and growth, particularly in the trade sector. Generally speaking, financial conditions are fairly strong and are supportive of growth. There are a few caveats in there, but that's generally the case. Banks are becoming a little bit more lenient in their lending. Risk spreads have narrowed. Interest rates are low. Generally the financial conditions are supportive of strong growth, and that's reflected in very strong growth in what a large component of GDP we call private final sales to domestic purchasers. So this is a key measure of the underlying strength of demand in the private sector, and that's growing rapidly, 3 to 4% growth right about this period of time. So that's helping to really pull the economy forward. But there are some factors that are holding us back. In the near term, over the next few quarters, we're probably looking at some declines in inventory investment, which will temporarily restrain GDP growth. And of course, because of the strength of the dollar, some concern about foreign demand, we're likely to see further declines in net exports, and that's going to be exerting a little bit of restraint on aggregate growth. But that's not enough to derail the economy, either of those features. And in terms of financial markets, we look for continued gains in equities on a broad basis, but much less than we've seen in the last few years, but generally, as I noted, improving financial conditions. So that's kind of a big overview. I've got a handful of slides after this. I'll kind of dive through. Some of them will be very brief. The next slide, number 3, rising dollar and falling oil prices. This just puts a little flesh onto the comment I made a minute ago, which is the economy, both the U.S. and globally, has been influenced by, first, the sharp run-up in the value of the dollar over the last since last year, and also the very sharp decline in energy prices. and we're assuming partial reversals of both of those features over the next couple of years. If we sort of put all of this together, what does it mean for the outlook? And that's in the next slide. The bars in that chart are our forecasts of quarterly GDP growth. This is at an annual rate. And then the red line there, the solid red line, is the path of the unemployment rate in the forecast. So this is kind of, if you had to show the forecast in one picture, what would it be? That would be this picture. So we've got GDP growth, as was noted. You know, there's some signs that the economy may have slowed down a little bit in the last quarter or two. We're tracking Q4 GDP growth at under 2%, between 1.5% and 2% now, just based upon the incoming monthly data that we get. And Q1, we're looking at something in the low to mid twos. I think 2.3% is where we are today after the very latest report. So growth at the moment doesn't look that strong, but we expect growth to pick up, and it goes back to the point I made a couple of minutes ago, that in the private sector, private final demand is actually growing, particularly if you also pull out the net exports, is actually growing at quite a robust rate. We expect private final sales to domestic purchasers, this key component I mentioned, to be growing about 4% this year, and then growth well above 3% over the next couple of years after that. So that's really powering the economy forward. So GDP growth in the second half of this year, we think will rise to well above 3%, and then ease back a little bit into the high twos after the second half of 2015. Not spectacular by any stretch, but that's still solid growth, enough to put downward pressure on the unemployment rate. I'm going to skip over the next slide, which just has a little color to my comment that financial conditions generally are improving, and jump over to slide 6, entitled Receding Fiscal Drag. The point of this slide is to say, okay, I've talked about the private sector and the relatively strong performance we're seeing right now in sort of the underlying strength of the private sector. What's going on in the government sector? And as we all know, after the Great Recession, we had massive stimulus policies in an attempt to kind of pull the economy out of the recession. And as we got on the back side of those, that stimulus was falling off. And that led to a lot of drag on growth over the last few years, particularly up through 2013. 2014 was a bit of a transition year, and as we go into the forecast, we actually expect a modest boost to growth coming about through fiscal policies, both state and local levels on an aggregate basis and at the federal level. Now, it's not worth a lot. We're talking a couple of tenths of a percentage point in terms of annualized GDP growth. What's important is we don't have that big drag that we had in years past, and so that's one of the reasons it's sort of reinforcing our expectation for fairly solid growth going forward. I mentioned with strong growth, solid growth that's somewhat above trend, we expect the unemployment rate to continue to decline, and generally for labor markets to continue to heal. We look for payroll gains on a monthly basis for the entire U.S. to average about 240,000 persons per month over 2015, slowing to about 180,000 per month on average in 2016 and somewhat less than that in 2017. As growth slows, we think employment gains will also slow down. We also expect a little bit of some firming in productivity growth, so that means less of that growth in output that's in the forecast translates into employment growth. But still, you'd characterize this as pretty strong performance in terms of labor markets, certainly getting better. We think the participation rate, which has been declining for years, is likely to level out. In fact, there's signs that it has done so over the past year. So as the unemployment rate's declining, as workers are being drawn back into the labor force because their experience, so what they see, there's more employment out there, employment's growing, unemployment's falling, the duration of unemployment is falling, and we expect it to continue to do so. We're going to see an increase in the employment to population ratio, a key sort of measure of what's happening to the employment experience of adults in the aggregate through the economy. I'm going to skip the next slide in the interest of time and jump forward to slide 9, oil price drop and dollar rise depress near-term inflation. And here I want to kind of use this as a vehicle to talk a little bit about the inflation outlook. And there are a couple of cross currents going on. One, as we all know, inflation has been quite low of late for two reasons. One, we've got declines in energy prices, as we've talked about, and that's holding down, much lower prices for crude oil are translating into lower prices for things that consumers care about, gasoline perhaps the most visible. And that's helping to push down headline inflation. In fact, some of the monthly numbers on inflation have been negative of late. We had another big decline in energy prices in January, for example. So that's holding down headline inflation. We expect it will continue to do so for a little while longer, but if energy prices kind of flatten out and then begin to drift back up, that development's going to reverse. So underneath this, we also look at what's happening in inflation outside of the energy components. And we talk about core inflation, excluding the direct effects of food and energy. Core inflation is also low, not negative, but low. somewhere in the low 1% range, 1 to 1.5, depending on which measure we look at. Now, the Fed has established a target for inflation over the longer term of 2%. We believe that as the effects depressing inflation from lower energy prices and a stronger dollar gradually dissipate, and as the economy continues to strengthen, inflation will be pulled back up towards long-run inflation expectations, which are also very well anchored at 2%. So we expect a gradual rise in core inflation, and then layered on top of this are the effects of the swings in energy prices. So if you look at headline inflation, also including energy, not just the core, that too we think will settle in around 2% as we move out about 1.5 years to 2 years from now. Let's talk a little bit about the Fed. Obviously, labor markets and inflation are the two key factors that tend to influence Fed behavior. As I mentioned, we anticipate that the Fed will begin its tightening regime later this year. We're assuming the first tightening will occur in September, and I think there's risk to either side of that, but September, I think, is a good date to anticipate the first tightening. Initially, after that, the tightenings may not happen that rapidly, maybe every other meeting. But as we move further into 2016, we think the most likely path is to have quarter-point hikes in the Fed funds rate at just about every meeting, so that by late 2017, the funds rate we think will be back up to 3.5%, which is what we peg for sort of the long-run equilibrium value for the Fed funds rate. Now, a key question is, how are financial markets going to respond to that? Certainly, other interest rates are going to be pushed up. Long-term Treasury yields, private bond yields, and so forth are going to be pushed up. Mortgage rates are going to be pushed up as the Fed's tightening, and even in advance of that tightening. But will that response by financial markets be continuous and smooth and well anticipated, or will it be just the opposite? Will it be somewhat discontinuous? And as was noted earlier, not every tightening cycle has been accompanied by a nice, smooth progression in response of financial markets. So there's some risk that financial markets could respond in a discontinuous fashion, that there could be some upset along this path to renormalization. That's certainly a factor to keep in mind, or a risk factor to keep in mind. But still, even with those increases in interest rates, even by 2017, rates are still low in historical context. So in and of itself, higher rates are not an impediment to growth and strong performance, even though there are some risks about it. I think the last slide with sort of numbers on it that I'll mention is number 12, leading to improved household balance sheets. With equities continue to expect to rise, we expect modest gains in broad equity indexes over the next few years, not as large as what we've had recently, but moderate gains as profits and dividends continue to rise. That's going to support further increases in household wealth, along with rising home prices. We've had big gains in household wealth over the last few years, a very strong recovery, and we expect continued gains, albeit at a smaller pace, over the next few years. That's important because it really reinforces the strength in the consumer sector. So I mentioned that consumer spending early on is growing pretty rapidly now. We're tracking growth, 3.5, almost 4% in some cases in terms of real consumer spending. So the outlook there is strong, and in part it's because of these wealth effects. The other thing that is declining energy prices are putting a little bit more real purchasing power in households' pockets. That's also supporting strong growth in consumer spending. But it's important to bring the financial aspect back in and circle back and sort of complete the circle, say that's one reason why we expect fairly solid growth. So I'd say that's a fairly sanguine outlook. We're cautiously optimistic, but I can't end without noting that there are a number of risks. In the last two slides in my handout, list a very, very brief list. We could make much longer ones if we had time about a number of the risks to the outlook for the U.S. economy. And the point I would stress, I'm not going to read these back to you. You can look them over. There's a number and many more. But the one point I would make is that the risks are not one-sided. They're not just downside risks or just upside risks to the outlook. And I'll give you a couple of examples. It's easy to focus on downside risks. I think financial markets, to some extent, if you look at, for example, the very low level of long-term interest rates, Treasury yields suggest there's a lot of focus on downside risk. But here's an upside risk. Wage growth has been fairly anemic coming out of, during this recovery. There's been just very, very little pickup in the growth of wages. But as labor markets tighten, as businesses see more growth in demand and output, as the unemployment rate falls, as businesses have to work harder to recruit the kinds of employees they need, I think we're going to see wage growth pick up. We've got some of that in our forecast, but I think the balance of risks there are probably tilted to the upside. If that happens, that makes the outlook for consumer spending and GDP growth in general look a little better, maybe even than what's in this packet here. So with that, I'll end on prepared remarks. I don't know if you want to do a little Q&A for a few minutes.
Yeah, I know that Ken may have to leave a little early to catch a flight, so if anyone has questions now for Ken, move on to Mr. Dixon. Anyone? Thank you. Moving on to, I think we're still might be waiting, so why don't we move on to James Diffley?
Thank you. Good afternoon, everyone. Glad to be here again. Anticipated you speaking ahead of me as he usually does. So let me report on IHS's projections for the nation and the state in the context of this budget process. First, so we've got a slide set here that I'm sure you all have. U.S. economic expansion will continue. We have, as the director said, a windfall to American consumers and costs across the board in terms of oil prices. I shouldn't say across the board because there are negatives that we'll come to in terms of the effect of higher oil prices. But clear accelerations in consumer spending that outweigh all the some of the offsetting factors. And home building, we hope, will boost real GDP growth from 2.4% last year to 3.0% in 2015, which will be the best year since 2005, the strongest growth in GDP for a year. Consumers step up spending in response to the lower energy prices and robust gains in employment that have now shown a very momentous labor market in the last half of last year, coinciding with real income gains and net worth gains at last. The recovery in home building, which is on shakier ground than the other things we're talking about, but we think will gain momentum as labor markets improve and credit standards ease, as they have been, at least gradually. A strong dollar, all right, largely because of the effects of the now favorable turn in terms of the balance of payments with given low oil prices, will be a negative on the net export sector, reducing the demand for U.S. exports, increasing the demand for imports by virtue of the exchange rate. There will be cutbacks, there have been cutbacks in energy-related oil and gas development investments, not so much affecting New York State directly, but it does affect indirectly in the supply chain, but in various pockets across the country. We still think, by the way, just to give a little regional flavor, that Texas will be one of the leading states in growth over the next few years, but at a more muted rate than it has been in the past. Okay. And a slowdown in inventory accumulation will also be restraints on measured GDP growth. Interest rates are set to rise. I mean, we've been watching it for a while, and Fed Chairman Yellen gave a very detailed speech earlier in the week. So we're looking at, over the next 3 years, interest rates coming up similar to as Ken pointed out, as this monetary accommodation to boost the economy is gradually withdrawn. But we think the Fed is well capable of handling the transition. The price of now dated Brent crude oil, the standard, is expected for us to average $47 per barrel this year and $63 in 2016. So I don't see it coming up very much in 2018, but it will come up a bit in 2016, but nowhere near the $100 levels that we, until very recently, had been expecting. Right, so a major boost for American consumers. Second page of the handout shows a graph of real GDP and unemployment rate, both historically and in our forecast. You'll notice the blue line coming up and down. That's measures a 6 long years of a cycle with unemployment rate rising dramatically to almost 10% for the nation and coming down continually till now. The rate of decline in the unemployment rate will naturally fall off because we're getting closer to full employment. Will fall off in part, though, because, as Ken mentioned, labor force participation is being encouraged, and that will add available labor force, which tends by itself to boost the unemployment rate, at least in a measured sense. But they'll be able to get jobs. Job growth will be strong. GDP growth, you see the huge vertical green lines just before 2015. That's the last 2 quarters of 2014. We'll have an average of 3% for the upcoming year, 2015, or this year, 2015, and consider continual strong growth as opposed to the GDP numbers we've seen between, say, 2011 and 2014, where it was a few strong quarters followed by weak quarters, et cetera. And that's why we come up with finally 3%, which is a healthy long-term rate of growth for the U.S. economy in terms of real GDP. If you turn to the next slide, we have a table of GDP, real GDP, and its components. Real GDP, you see the 3.0 in 2015, as I said, the best since 2005. Consumption, remember this is real terms, okay? The state collects nominal dollars in sales tax, et cetera, but consumption is going in real terms above 3%. And these are calendar year measures, by the way, here, 3.6% in 2015, 3.3% in 2016, almost 3% in 2017. Residential investment, mainly housing and housing starts. It's been up and down for the real estate recovery, as you may know. Only 1.6% gains in 2014. We do see double-digit gains, though, in the next 2 years. That's the most fragile part of the forecast. Home sales at the start of 2015 have been weak, somewhat weaker than expected, so we'll have to watch those. Business fixed investment, less than a 6% in 2014, but still a healthy, and remember, these are in real terms, right? Inflation-adjusted terms, almost 5% this year and almost 6% next year. Federal government, a modest drag on growth. State and local government now positive. The net export sector, exports minus imports, the exports growing at a rate that boosts the economy, 3.3%, that's fine, but imports are growing even faster at double that, and that's largely good, largely the consumer side. Okay, the next slide, let's talk about labor force participation. As you see our view of it, labor force participation has been a bit puzzling. The question is, why is it so low? Part of that is demographics, an older workforce, and part of it, of course, is the lingering effects of the recession and the vast increase in the long-term unemployed. Because of the population aging, though, we don't think the labor force participation rate, which will be coming up if you look at the blue line to the right of the vertical line, which is the edge of the forecast, we do see it coming up a bit, but not reaching previous levels, which you see in the 1990s of above 65%, which is measured labor force as a percent of the working age population. So the unemployment rate, while coming down, at least initially, will be coming down a little slower than it has been, but nevertheless, so the upshot of this is labor force growth is going to be smaller than we have expected in the past. So job gains, once we get back to full employment, are going to be at a slower rate than you might have expected a couple of tenths. And the same is true in New York. On the other side, we also agree wage gains have been muted. The next slide. Labor compensation, we do expect to accelerate finally. Many of us expected 2014 to be a breakout year in that regard. We're now hoping 2015 will. You see the blue line there in benefits, but also wages and salaries in the total compensation. At faster rates, this is a growth rate chart, so faster rates than we've seen since 2008, basically. Okay. That's a benefit going forward. Next slide is our view on oil prices, which I mentioned. Just briefly, to put this in context, the unconventional supplies of oil in the U.S., particularly, and the Bakken Shale in North Dakota, which, as you all know, a lot of it flows through New York State from Buffalo to Albany and down the Hudson. And other unconventional sources across the U.S., including Pennsylvania, have greatly increased the supply of oil. That was somewhat masked for a couple of years by the disruptions in Iraq and Libya, right? So it didn't depress prices as much as it would have earlier, a few years ago. Now with those countries now producing a lot of oil, now suddenly Saudi Arabia saw that the equilibrium price in the market would come down dramatically. And unless they cut back, and they decided not to cut back, so they let it come down. And that's the basic story. We see oil production slowing in the U.S. in the second half of 2015 and around the world, of course, in response to lower prices. So there's a bit of a lag in the negative response of the low oil prices, in terms of reducing oil and gas investment in the U.S. and the multiplier effects of that. So we get a bit more of a drag on growth from that factor in the second half of the year. It doesn't outweigh the stimulus from increased consumer spending at low oil prices. So we should be for low oil prices by all means. But there is a negative impact that we'll see loaded to the second half of the year as opposed to the first half of the year. And that explains sort of quarterly pattern that we see in real GDP growth, or at least part of it. Okay? On the next graph, the graph shows how much that means to U.S. consumers. Here we plotted the retail gasoline price and our forecast of it, by the way, under that scenario. We do see ultimately oil prices recovering in the world market, but the big drop here, and related to that is on the right-hand scale, spending on motor fuels per household. So this is the direct windfall to U.S. consumers. How much they spend on gasoline at the pump and how much that means to them. It's about, if you look at the graphs, it's about $1,000 per year is the benefit from the recent reduction in oil prices. So that's a direct stimulus. It happens for everybody in New York State, every driver, for instance, in New York State, and you can see the positive impacts it has. Next slide, we do think the recovery in housing markets will strengthen. I mentioned labor force participation. One of the things that happened after the recession is we started talking about what the new normal might be in terms of household behavior. One of the factors that we were concerned about, we had to watch, we recognized we had to watch, was the change in labor force participation going down in the recession, and would it recover? Okay, big question going forward. The second part is the change in household formation, which dropped dramatically during the recession for obvious reasons. You know, students came back home, young adults came back in households. Households were generally bigger. That was not a surprise during the recession. But at the same time, because of the housing bust, big houses became somewhat out of fashion relative to the past. And we were wondering about a change in household conditions. And there's an open question as to how strong household formation is going to be going forward to support real estate construction markets as healthy as they had been in the past. The recent data have been disappointing in that regard, even in 2014. Household formation as measured by the census, which, by the way, is measured with a great deal of error, so you shouldn't, great deal of volatility. You shouldn't take it too seriously, but there is a concern there of the new normal, including lower rates of household formation, which means the real estate markets in general won't come back and be a driver for economic growth going forward. So what's happening now, though? The recent job growth does increase housing demand. Now, last year you saw a moderation in home price inflation. We saw not incipient bubbles as we saw in the last decade, although some could argue that in for instance, the Bay Area in California, in San Francisco, but certainly not here, maybe except in Manhattan apartments and high-end housing there. But the moderation that we saw through 2014 increases affordability once again and helps get people into the market. The lower income and younger part of the general homeowner demand segment has been hampered by much tougher credit conditions than in the past. You know, the standard now is to require a 20% down payment, which was relaxed quite a bit, too much during the bubble, but it could be a little lower than it was now, a little more flexible now. And then there's the reduction in home equity that a lot of people had in their existing houses that they lost in the bubble. So we're still having trouble in the low end of the market, the lower income levels, lower house price levels, getting demand. And at the same time, because families because of low equity, are discouraged from moving, that also decreases the supply of homes in that segment too. So the high end of the market, $1 million houses, high income houses are doing better now, and we're hoping that the rest of the economy will follow, particularly with improving job conditions. The supply of buildable lots we thought was a problem, partly due to credit conditions because the prospective builders had to get credit availability there too. Multifamily units jumped up in proportion, and they're still going to account for about 1/3 of starts, but the single family market is the one that's really coming back. Young adults, as I mentioned, delaying home ownership, and baby boomers, the flip side of it, the older generation starting to downsize away from the McMansions, which puts downward price pressure, of course, on those houses, which we'll have to watch. Okay. Next slide, the multicolored slide, is risks to the forecast. Director mentioned preparing for not so much downturns, but weaker growth than we've had in the past. So that's something we do all the time. We always have 3 scenarios, a baseline and both a positive and negative, and we put probabilities on them. Right now we've got equal weighted, 15% to the high side, 15% to the low side. The low side includes a low household formation, you'll notice in the bullets there. I won't get into the rest of it. But what's the high side? Oil prices falling further, housing markets rebounding to more healthy levels quicker than we thought, and then global economic growth lifting U.S. exports. The European economy been in tough shape. We're hoping to get out of the mess there. We'll see what the resolution of the Greek crisis is, but it does bode ill for the general European economy, which is a strong driver of growth. China, for exports, China is decelerating. All right, it's still going to have healthy growth, but decelerating relative to what it has been. India, on the other hand, is poised for stronger growth. So those are part of the scenarios that we weave together. If you turn to the next slide, you see the implications of those scenarios in terms of at least one factor of interest here, real consumer spending. Between the red and the green lines is a total of 5 percentage points in difference, and that would translate to 5 percentage points in whether you're thinking of real or nominal spending. That's plus 3% on the upside in our optimistic scenario, minus 2% on the low side in our pessimistic scenario. Again, with roughly 15% probability on either side. Turning to the regional outlook, we've got a couple of maps here. And the major thing we see, here we're looking at growth, job growth in the next year, in the upcoming year through 2015, state by state across the country. And you'll notice New York, in the lowest segment of that, we've got about between 1.2 and 1.4% for New York State in the tan or gray section there. The South and West lead. All right? Now, part of it, first of all, it's already in place. That's what 2014 looks like. But there's one other factor you need to consider here. The South and West still have a lot of what you might think of excess capacity, both in the business and labor markets. Their recession was deeper than New York. New York, very early in the recovery, regained all the jobs lost in the recession. So did Texas and the midsection of the country, but California and Florida were way behind that and continue to be way behind, particularly the Southeast with Florida. So some of the growth rates that we see going forward, right, are telling us is healthier growth in the South and West now than in the Northeast, particularly New York. But part of it is just a catch-up. All right, so if we look over the course of the whole cycle, New York's actually done pretty well. But that said, having done that, the expected growth going forward, in our view, is going to moderate. And I'll come back to the numbers in a minute. Let's show the next map goes to the near term, 2015 to 2019, the next 5 years. And again, you see, not surprisingly, there's a similar picture of more moderate growth in New York and the Northeast and Midwest than you see across the country. On the next slide, I look at the sectoral detail of New York growth. And I agree with the director's comments here that there has been a shift or greater health in the high wage segments, particularly in what you see here is the 3.5% in professional and business services. But overall, employment growth has been lagging the nation. Most notable thing about this is the financial sector being very, very low, which of course we've discussed here. Very little growth, and I know Ronnie and I think Jason on the phone are going to talk about New York City in more detail, so I'll leave that to them. But it's very interesting that New York's growth up to this point has not been boosted by the typical driver of growth, which is downstate finance. Okay. Looking across the metro areas, the next bar chart, New York City, not surprisingly, leads. Right, I've given the broader New York metro there, by the way, as well as New York City itself. Upstate New York, particularly Syracuse, Utica, midsection is weak. Buffalo is not exceptionally strong, but there's great promise in Buffalo. I've spent a lot of time in Buffalo recently, and the Buffalo Billion, I think, is called by the governor. But there's a lot of developmental activity downtown, and in the area, a lot of optimism about going forward for Buffalo. Next map shows home price growth. This is actually through the third quarter of 2014, the latest data. Again, weaker real estate recovery now in New York, and that's generally actually true over the course of the cycle, except for New York City. Well, the bubble wasn't too high upstate New York anyway, but the rate of expansion in real estate markets is slower than the rest of the country right now. put that in perspective. We do have our forecast on the next slide, the bar chart and graph both of housing starts and average home price. You see home prices recovering by the end of the decade to their peak across the state, and by some measures they have already. This is one particular measure based on the Federal Housing Finance Authority. But I want to point out the bar charts there, the other bubble that occurred in the mid part of the last decade, and that was in building itself. And there we don't see that coming back in New York at all, okay? And the question is how close the country gets to their previous peak. But there were two, in other words, there were two bubbles. The price increases and then crash, but also the building increase. And the building increases are really affect the real economy as well, driving demand for construction jobs and the like. Summarized on the next slide is New York growth by different economic indicators across the fiscal years. This is fiscal year tabulations here. And you can see gross state product less than 2% for fiscal 2014 and into fiscal 2015, trailing the nation, as I said, but moving up in 2016 and 2017. And similarly, you see in employment and personal income. I'll make a note because I was reviewing the budget publication ahead of time. The Division of Budget adjusts their employment numbers for expected revisions, and they'll be out in a couple of weeks. So we'll see. We're using the existing BLS numbers, so that's why we're showing lower growth, even in fiscal 14, I believe. We are, though, a little less bullish or more bearish about employment growth in the upcoming years. So, but the actual level of the numbers is explained by that adjustment that the Budget Office makes. So what's the bottom line? Trailing the nation now. Part of that is due to the relative shift as the South finally recovers and the West finally recovers from the recession. We're trailing in jobs. Wages are not as disadvantaged, but the overall rate of growth we do see as lower than the nation, which is, of course, what you expect in the long term to some degree, just based on different demographics. New York City clearly leads the state. Most notably, though, not the financial sector in New York City. There is optimism in Buffalo, as I mentioned. The conclusion is that we're going to have growth. It's going to be moderate over the near term, over the budget cycle going forward. Thank you.
Can I interrupt? I don't mean to interrupt, but I've been getting some notes that nobody can hear me. Can you hear me?
We could hear you. Yes.
We can now, you.
Okay, I'm sorry to interrupt, but that's the notes I've been getting, and I thought I was plugged in, but I didn't know. Okay, I am on. So whenever you want me to speak, I'll be happy to speak.
Okay, very good. Let me just see, are there any questions of Mr. Diffley?
Yes, page 3. When you're talking about the unemployment rate, are you talking about all people unemployed or all people that are seeking employment that are not in the job market?
Right. This is the narrowest measure, which is those people who are in the labor force and actively looking for a job. What percentage of those people are not?
Do you have any estimate as the number, what the percentage would be if people that aren't in the labor force?
The BLS, the Bureau of Labor Statistics, has 6 different measures. The largest one is roughly double this. I don't know the number offhand, but you're right. It would be above 10% now.
And what are the factors in trying to get more people in the market?
Well, there's discouraged workers, for one, and that's the interesting thing when I talk about the labor force participation rate increasing and hence muting the further fall in the unemployment rate. That's getting those people back into the labor force. They come back in looking for a job. Think about the time lag here. When they don't find the job, they're counted as unemployed. So that by being unemployed now, as opposed to being outside the labor force, that tends to boost the unemployment rate. There's nothing negative has happened in the economy other than these people looking for a job. But with job opportunities expanding, when they find jobs, that then reduces the unemployment rate. Okay.
Well, I guess my concern would be if you're really hurting and you need food for the table,
Right.
You'll get a job. It may not be what you're looking for, but it's a job, and it puts less pressure on government forces having to take from others to pay for the person who chooses not to take the job. I think I've asked you the same question before. I don't even know when the unemployment insurance is expired. I know it was up to 99 weeks at one time. I haven't followed it. But how long can someone have get unemployment insurance or unemployment payments?
Well, the extension from, it's normally 12 months. The extension to 2 years has ended.
It's ended
Right.
as of when?
I don't have, I
Okay,
forget the exact
but
date.
is there-
Some economists have studied it and prescribe a couple of tenths of a percentage point increase in employment following the expiration,
And
because
that's where I was getting at.
Yeah.
Has there been any indication that that has happened, that
There is an
more
indication.
people looking for jobs?
there is an indication, there's a debate over the size of the effects.
Okay,
Okay.
where can I find the parameters of the debate?
Well, I'll give them to you afterwards, okay?
Thank you.
By all means. Well, one other factor, though. When I mentioned six different measures in the unemployment, one of them includes the group of people who are, for instance, taking part-time jobs, even though they'd rather have full-time jobs. And you also want to consider people who are taking, as you say, more menial jobs when they'd rather they have higher qualifications in that. All these things, an expanding economy will benefit all those things, reduce all those
Right,
adverse situations.
Very good.
thank you.
Anyone else? Okay, Mr. Johnson, we're going to give you a try. Hopefully,
Thank you very much, Madam Budget Director, and I commend both Ken and Jim for their very comprehensive and useful discussion on what's going on in the economy. It's very hard for me to be able to say something that they haven't already touched on and given you all the information that you really probably need. But at any rate, thank you very much, and hopefully you can hear me clearly. That's important. And once again, thank you very much for inviting me back to participate in a pretty important part of the budget process. You have a handout, and I'm not going to labor through the handout. I'm just going to try to hit what I think are the important points that are contained in the handout, and you can sort of fill in by reading the handout or add to what I'm going to say. The approach that I've had in the past in talking to you, and the one I want to pursue today is, which is first of all to start with what I take to be the most important question that faces not only investors but also faces policymakers such as yourself, particularly a part of the budget process, and the real key question, the most important, crucial question is do we have further to go in the current stock market economic expansion interest rate cycle? And if we do, that's good news, and obviously if we don't, that's not such good news. What I like to do is to take a look at the financial markets as giving me an idea, a fairly good idea, probably better than forecasters, as to whether indeed we have further to go in the current cycle. And if you look at the performance of the financial markets, and I talk about both the equity markets as well as the fixed income markets, as well as all international markets, if you ask the question based on the performance of the financial markets, do we have further to go in the current cycle? An answer which has already been both implied as well as stated by Ken and Jim is the answer is yes. Now, I would add, importantly, that there was a time between January of 2014 and the so-called correction low of October of 2014 when you begin to question that or ask the question or basically have the impression that maybe we don't have further to go. Given the performance of the financial markets since October 15th, the equity markets and the fixed income markets, you have to conclude that the message of the financial markets is indeed that we do have further to go in the current cycle. There are some variables, I'll call them internal fixed income variables that seem to be suggesting otherwise. For example, the spread between corporate bonds, BAA corporate bonds and 10-year treasuries has begun to widen, suggesting that fixed income investors are concerned about something and unwilling to take greater risk. But generally speaking, if you look at the performance of the broad-based stock market, sectors within the stock market, capitalization within the stock market, even the yield curve, you're left with the impression we do have further to go in the current cycle, which, as I mentioned, is fairly good news. Not only is that the message of the financial markets collectively, but that message is, in my view, confirmed by what I take to be pretty important monetary and economic variables. Obviously, Federal Reserve policy has been accommodative. Understatement of the year. In addition, as was mentioned by the two previous speakers, we're seeing a pickup or even an acceleration, maybe that's too strong a word, in bank lending. Money growth is certainly a strong or certainly solid. Liquidity conditions are positive. There's enough liquidity to drive both the economy and the financial markets. And all of this shows up in leading indicators for the economy, which have continued to expand, having expanded in 10 of the last 12 months, being unchanged in 1 month and declining in one month. So from 30,000 feet, looking at the performance of the financial markets and the performance of what I take to be important monetary and economic variables, the outlook is positive, or the current bull market, economic expansion, and eventually we'll get to it, rising interest rate environment will continue through 2015, and with a little luck, 2016 as well. In addition, after having sort of looked at it from that point of view, I've included in the handout, I've included what a couple of tables, one which shows the consensus forecast for a lot of the numbers that you're going to need to use in forecasting revenues, numbers that I take from the consensus as measured by blue chip economic indicators. It's about as good as anything. I also have a table in there that shows my forecast. Essentially, the first question, everybody, and I include macroeconomic advisors and IHS, are generally around the same number on overall economic growth for 2015 and 2016. I take a look at not just their numbers, but also the numbers that I just got, which show the view of the Department of Budget, Senate majority, Senate minority, Assembly majority, Assembly minority, on gross domestic product, or the top line of economic growth, and everybody's pretty much around the same number for 2015 and 2016, essentially around 3%. I don't think there's any reason to strongly argue with that. As I've said in the past, there's a little bit of whimsy to the level of confidence I have in the forecast for, let's say, 2015. Through the forecast period, the two-year forecast period, you tend to see the consensus pull in one direction. It starts either too high and continues to decline through the two-year forecast period, or it starts too low, it tends to rise. This time, sort of uniquely, the consensus forecast for 2015, and again, that's around 3%, has been pretty flat, suggesting, and again, this is whimsy as opposed to economic research, suggesting that the current consensus of around 3% is probably the right number. What has been mentioned, which is a little bit odd, is the well, I don't know if I call it odd, but what has been mentioned by certainly by Ken is the numbers that you're going to look at for inflation, both headline inflation and core inflation, but particularly headline inflation. And when you get to that number, you're going to see, most likely, you're going to see a year-over-year number for 2015, which is below 1%, and a year-over-year number for 2016, which is either just below 2%, the Federal Reserve's so-called target, or just above that 2% target. I see that the so-called sort of five-way average, Assembly majority, et cetera, is 0.2% for 2015 and 2.2% for 2016. I think 15 is going to be higher than the 0.2. I have it at about 0.9. forecasting inflation, believe me, folks, is extraordinarily difficult. And I have it a little bit below that 2.2% for 2016. So I, quite frankly, would probably come up a little bit on the 2015 five-way average of 0.2%, and I think the 2016 number of 2.2% is probably about right. I don't have any reason to really differ strongly. A lot of the other numbers, whether we look at corporate profits, non-farm payroll employment, and personal income and wages, I would probably stay fairly close to what I'm looking at, which is the five-way average. Yes, I have personal income at less than the 4% of 2015 or 4.4%. Yes, I have wages at less than 4.5% for 2015. But there's a very strong consensus among the various forecasting units of the roughly 4.4% and 4.5% for income and wages. I would most likely, even though I'm a little bit lower, probably stick with those numbers. These are important numbers because they're going to ultimately drive your forecast for revenues. 3-month Treasury bill rate, you're probably fine on 2015, but too high on 2016. The number you have for 2016, which is 1.5% average for 2016 over 2015, implies statistically that the Federal Reserve is going to be far more aggressive in raising short-term interest rates than I believe is the case. So I think that number's got to come down. I might add that I agree with Ken that I was talking about June, but after listening to Janet Yellen and thinking about it, particularly looking at some of the more recent numbers on inflation, I think September is probably a better bet as to when the Federal Reserve has what we're now, I guess, calling liftoff or starts to raise short-term interest rates. If they start in September, the number of 1.5% that you have for short-term interest rates is simply too aggressive. It's too high. And I might add, importantly, that the yield on a 10-year Treasury, I don't think is going to get I'm including 2016, to get to over 3% until late 2016 at the earliest. In other words, the consensus forecast for longer-term interest rates, in my judgment, is also simply too high. Those are numbers which you might want to adjust as we take a look at things. I also have in there numbers about New York State, numbers that have been referred to already, New York State and how New York State is going to fare compared to the national economy, as Jim has suggested, whether I look at the index of coincident economic indicators for the U.S. or the New York, or I look at the growth rate of non-farm payrolls for the U.S. and New York, the unemployment rate, growth of the labor force, it's going to continue to be the case that, to lack of a better way of saying it, that the New York State economy is likely to hover below the national numbers. So, for example, with the growth rate of the national economy, growth rate of non-farm payrolls being about 2.0, maybe a little bit above that, I would agree with Jim that we're probably going to be closer for New York State, about 1.4% for both 2015 and 2016, which is below the results we're going to see for the nation as a whole. I might add that there are a number of metropolitan statistical areas in New York State, and these are across New York State, upstate New York, which are likely to experience, with one exception, Elmira, but experience positive growth in payrolls in 2015 and 2016 for the 2 years. But you're going to see the ongoing disparity, I guess is the way to say it, or divergence between the growth of payrolls for downstate and upstate with areas such as Buffalo. Now, I understand about the upbeat assessment of Buffalo. I hear it myself, but when I crunch the numbers, and this could be misleading, I could be off base, but the numbers I get, Buffalo, Rochester, Syracuse, Elmira, and Binghamton, they're positive, but they're certainly not equal to what we see for New York State overall, or for various areas of downstate New York. There are some areas in upstate New York where I would forecast, interestingly and surprisingly, somewhat strong numbers. Kingston, Glens Falls, Utica, Albany. Interesting things going on there, I think, particularly in the Albany area. Federal Reserve policy I've already mentioned. As I mentioned, Ken and James have done a really good job on taking a look at Federal Reserve policy. It's pretty close to guesswork, but based on recent inflation numbers and what's going on the inflation side of things, and listening very carefully to Janet Yellen, who has made it fairly clear that the Fed is not going to raise interest rates at the next two meetings, that there's room, I guess, in her mind, for significant improvement in employment conditions broadly defined, and that although it's going to take time, over time, that the rate of inflation will approach that 2% number, and that gets to that 2% in 2016 that I mentioned before. But listening to what she has to say, I think probably the most sensible conclusion is to conclude that the Federal Reserve is likely to move in September. I also have numbers in there on what I think that implies for interest rates, and as you can see from the numbers that I have, that it implies statistically that interest rates are not going to be anywhere near as high, both short-term and long-term interest rates, as is currently forecast by the consensus. I have some numbers there on housing, which are fairly good. So it looks to me as though housing is going to be pretty close to consensus, if not a little bit above consensus as we move through 2016. Stock prices. I think this is pretty much implied or actually mentioned by both Ken and James, and that's that my expectation is we had really good years in obviously 2013 and 2014. The growth rate of profits, I think, is going to come down and be mid-single digits as it was in the fourth quarter. With the growth rate of profits, whether we're looking at corporate profits or whether we're looking at S&P 500 operating earnings, mid-single digits, that's not particularly good news for stronger growth and a stronger rise in stock prices. In addition, if the Federal Reserve is leaning towards restraint or starting to raise interest rates in September, that's not very good news for price earnings, the expansion of price earnings ratios. Price earnings ratios are likely to come down just a little bit. And if you put the two of those together, the two primary drivers of stock prices, again, profits on the one side, interest rates slash price earnings ratios on the other side, about the best you can do is make the case for, in my judgment, mid-single-digit growth rates or rise in stock prices, mid-single-digit average annualized rates of return. That's good news in some ways because it'll be higher than the bond market, which will be pretty close to 0 to 1%, but nevertheless, it's not going to be as good as 2013 and 2014, and that's going to have an impact, and not a particularly good one, on Wall Street, which gets you, of course, gives you a variable on thinking about revenues. We've talked about the risk to the forecast, emerging markets and developed markets or foreign markets, Europe. My expectation, like everyone else, is that the price of oil is going to go up to between West Texas Intermediate, between $60 and $70 per barrel. But having said that, the damage that's being done to the economy of Russia, I expect it to contract 3.5% in 2015. That will have some, but not a significant impact on Europe. It'll have some impact on the U.S. It's not going to derail the recovery or the cycle in the U.S., but it will have some impact. But we're currently seeing, to some extent unexpectedly, very good performance from the equity markets of Europe, relative performance relative to the U.S., and particular good relative performance of the Northern European countries, the UK, France, and Germany. We're also seeing the consensus forecast for those three countries start to stabilize or improve. And I'm also hearing anecdotally that there's improvement in Europe generally, but particularly the Northern European countries. So I think that we're not talking about a recession, and we're not talking about deflation in Europe, even though they're likely to be impacted by the events that are transpiring in Russia. But nevertheless, the economy is starting to look better, or it doesn't look to me as though Europe is nearly as significant a risk as I would have said 3 or 4 months ago. So that pretty much covers everything. I've looked at revenues, and it's interesting that I've got, just for an example, my personal income tax numbers or forecasts, if you may. It's not particularly sophisticated. It's good statistically, but it's not, in my judgment, something I'd hang my hat on. But for personal income tax numbers for 2015 fiscal year, 0.4%, 2016, 2.1%. So my numbers, I don't know where everybody else is on these numbers, but you can see in the handout that I've given you, I've got some fairly specific forecasts for different revenue categories. Overall, what this all says is this: the message of the financial markets is we have further to go in the current cycle. That's very good news. We can quantify it at about 3%, around 3% for 2015 and 2016. New York State being a little bit less than that. That carries with it specific implications for New York State revenues, which I've summarized in my handout. And then there's a lot of information, in addition, things we can think about as far as particularly different areas of New York State, some which will do well, some which will do, let's just say, less well. And that's pretty much it.
Any questions for Hugh? I have one. Thank you very much, Hugh. I just have one.
You're welcome.
I just have one question. The market was obviously very strong in 2014. Why do you think the Wall Street revenues were so weak in light of the market?
Yeah, that's a good question. I don't know the answer to that question other than I would say when you talk about Wall Street these days, and maybe this is not a good answer to your question, but when you talk about Wall Street, we're not only talking about proprietary trading or the financial side of their business, but also talking about the commercial banking side of their business. And my impression was that we saw some fairly significant deterioration in margins on the commercial banking side, and there, even though the stock market did well and the bond market did okay, there wasn't really much on the proprietary trading side of things. So I really don't know the answer to that question, and I'm just sort of flopping around here, as you can tell. I'll try to get you a better answer and send it to you. But it's a good question and a tough question to answer.
Yeah, we've been puzzling over it too. So.
Yeah, it's not it's not obvious, but it's not obvious. It's just none of their businesses really did particularly well.
Yep. Well, thank you for that. Anything else? Okay, we'll move on. I believe Jason is from Federal Reserve is hopefully still on the phone, and I know he has some time constraints. So, Jason, are you with us?
I am. Can you hear me okay?
I was looking. Yes. I was looking.
Great. Okay. I'm going to try to go pretty fast to leave time for Ronnie's presentation. So I'm Jason Bram with the Federal Reserve Bank of New York. I should preface this by saying that the views I express are mine and do not necessarily represent the views of the Federal Reserve Bank of New York or the Federal Reserve System. And I assume everyone has the chart package, so I'm just going to go through that kind of quickly. First, I'm going to look mostly at employment trends and take a quick look at housing. And I know Ronnie will fill in more on housing and especially on wages, which I'm not really going to talk specifically about. So on the first chart, what we've done is we've just looked at trends in private sector employment. They're all indexed to the beginning of the recession at the end of 2007. And so when the index is at 104, it means that employment is 4% higher than it was at the start of the recession. So basically, New York and the city, the state, upstate, all of New York saw milder job losses than the nation during the recession. And as Mary Beth noted earlier, there's lots of variation in strength across New York State. So you can see that New York City is going gangbusters. It recovered quickly and has continued to grow rapidly, whereas upstate, and especially parts of upstate New York, have lagged the U.S. somewhat. And then if you go to the next chart, you can see a little more that upstate New York itself is mixed. I was going to try to put all the metro areas on here, but it just looked too crowded. So I put Buffalo on here, which is nice because Buffalo seems to be, a lot of people seem to be talking about it. But I'll just say that Buffalo is kind of representative of what's going on in both Buffalo and Rochester. They're kind of doing okay. They've reversed all the job losses from the recession, and they're growing at a moderate pace. Albany and Ithaca are going gangbusters, not quite like New York City, but are definitely ahead of Buffalo and ahead of upstate as a whole. And then you have Binghamton, Syracuse, Elmira, and Utica, Rome have been lagging. They haven't really reversed the job losses that we saw during the recession. And you can see here Long Island, also fueled in part by New York City, is doing moderately well, still ahead of the U.S. The next chart looks at we have two business surveys. We have a survey of New York State manufacturers and a survey of service firms throughout the district, but mostly in New York State. The diffusion index it's really quite a simple index. It's the difference between the number of firms saying business is growing versus business is shrinking. So when it's above 0, then the growing firms are outnumbering the shrinking firms. This is over periods of a month, so it kind of jumps around a little. What you see is that these indexes have mostly been above 0 in positive territory, kind of at the same levels that we saw before the recession and right after the recession. So things are in a growth mode. We tend to keep an eye on this because when it goes below 0, we get a little bit nervous and it sort of acts as a yellow flag. And you can see that the service sector survey, which is the blue, it might not be in color on yours, but it's the line that is kind of down at the 0 axis in February, is the service sector survey. We're not too concerned about it. One of the things, that could be affecting it is weather. And you see that in early 2014, when we had a lot of snow, and especially in late 2012, you can see the thing plunged well below 0. Late 2012, of course, was Sandy. So we're not too concerned about that, but it's something that we like to watch, and we're expecting and hoping it to rebound in March and the months ahead. So anyway, these are just indicators that we like to watch because they're very, very timely. Now to switch gears a little, let's look at a few key industries. We've been talking a little bit about Wall Street and the securities industry, and this is a chart that I've been showing for a while. And before this recession, I used to show it to say, you see, whatever the securities industry does is what the rest of New York does. So when the securities industry turns up, when it's doing well, then New York City's typically growing. So that's the left scale. It's the blue line. I don't know if it's in color, but it should be the darker line than black and white. And each up and down cycle, the securities industry tends to precede or lead total employment by a bit. And you can see that during the recent experience, basically the securities industry employment has done nothing. It's been flat. It fell quite a bit during the recession, and it's been flat. And everything else has been going, not everything else, but everything else as a whole has been going gangbusters. And it's really kind of surprising because it's never happened in New York City. You've never had a period in New York City where the city's done really quite well when the securities industry has been a laggard. And then the next graph just kind of zeroes in a little bit more on the recent period. So you just sort of get a closer look at what's been going on lately. So if the securities industry isn't driving it, what is? So the next page is a big table of numbers. Without going through all the numbers, I'm just going to highlight a few things. First, on the bottom line, you can see what you saw in those first charts, is that total employment, New York City is doing better than upstate, and on par, at least over the last year, with the nation. But when you look at the individual industries that are leading things, you can see financial activities is kind of sluggish. But you see that industries like professional business services, leisure and hospitality, education and health, and to some extent retail trade, at least for New York City, but even for New York State as a whole, tend to be doing better than the others. And what some of these industries have in common, which is a concern, is that obviously the finance sector is a very high-wage industry. And obviously leisure and hospitality and retail tend to be very low-wage industries. But what I think goes unrecognized often is that within, and again, I didn't want to get into too much detail in this little table, but within the professional business services sector, and even within the information sector, which as a whole is falling, you have pockets of tremendous strength in what I would call information technology, high-tech industries, things like internet publishing, computer systems design. These are areas where growth is really doing very well in New York City and in New York State. And it's something that we're looking into more. Maybe if I don't want to dwell on it too much, but it's also a source of very high-paying jobs. We looked at a group of what we considered to be high-tech industries in New York City, and even at the national level, they pay over $100,000 per year on average. So this is kind of a counterpoint to what we're seeing a lot, which is also growth in lower-wage industries. So it is a mix. And the technology sector, I think, is something that is hard to watch because it's scattered through different industries, but is important to watch. And I'll just wrap up. I know Ronnie has some more detailed charts on New York City home prices, but this is a CoreLogic. They do a house price index that's based on repeat sales. So it's not really affected by changes in the mix. You know, if all the houses 1 month happen to sell in the nice neighborhood, you don't want, it affects the median price. So you can see that U.S. home prices fell an awful lot during the housing bust and up as late as 2012, and they've certainly recovered, but they're not back to where they were. New York City Metro, and probably New York City is doing better than the Metro as a whole. They have recovered. And in upstate, which I think is really quite interesting, upstate didn't have a big housing boom, bubble, whatever you want to call it, from 2000 to 2007, but it also didn't have much of a bust at all. And it's now growing at about 3% home prices. This is in the places we've been talking about, like Buffalo and even Rochester, and even some of the cities that are not doing that well in job growth. So you see at least housing markets in New York State seem to be doing pretty well. And I think I'll just wrap it up there, but I'll be happy to take questions if there are any.
Thank you, Jason. Any questions? No. Okay, thank you very much. Why don't we move on to Ronnie Lowenstein?
Thank you very much. And thank you, Jason, for giving me enough time. I'm going to be doing something. I'm going to be doing something different, looking strictly at New York City, which is what our agency is charged to do, specifically focusing in on employment and wages and housing. Most of it's historical, but I've included some portions of our upcoming forecast, which is coming out later, I guess midweek next week, and may well be subject to change since we haven't quite pinned it down yet. What I'd like to do is start with just some perspective on just how strong the current expansion has been. So if you turn to the first page in your packet, what I've given you here is a look at job growth over the last 3 expansions. The vertical axis shows the cumulative increase in employment. The horizontal axis shows you years. And if you look at the first line, which is the red line on top, that's the most recent recovery. And if you look down from the very top of that line to the horizontal axis, you can see that in the roughly 5 years that the city's economy has been expanding, it's gained about 12%. The number of jobs have increased by about 12%. That's extraordinary. And you can tell that it's extraordinary by looking down. So if you just come down from that 12%, you look at the recovery from the 2002 recession, and you can see that, first of all, that recovery didn't make it 5 years, but when it finally ended, employment had increased by just 8%. And even in the very, very long recovery we saw after the very deep 1991 downturn, at the 5-year mark, employment growth was just 7%. So that gives you, a visual chart to just how strong the recovery in the city has been. If I had done this same chart on the basis of wages, it wouldn't look nearly as good, because what we've seen is really strong growth in employment, but not nearly as strong in wages. Continuing on with the good news on employment, turn the page. We're continuing to see strong employment growth. Based on the numbers that are currently available, New York City added more than 86,000 jobs in 2014. That's the 4th straight year of 80,000+ job gains. We've gained 3 times as many jobs during the recovery as we lost during the downturn. Moreover, we're going to be seeing revisions to this number probably within the next 2 weeks. And based upon our partial look at those revisions, we expect that employment growth for 2014 could well now top 100,000. And if it does, it will be a record for the city, since these records started being kept in 1950. At the same time, the city's rate of unemployment, particularly over the last year and a half or so, has fallen sharply. In fact, it's fallen 2.5 percentage points over the last 16 months. Jim mentioned the importance of labor force participation. For the longest time, the cities, even though we were growing jobs, the city's unemployment rate really wasn't going down very much because our labor force participation has continued to rise. People were coming into the labor market, and when they come into the labor market looking for work, they're counted as unemployed. But now, despite the fact that labor force participation is continuing to rise, we've seen a 2.5 percentage point drop in the unemployment rate over 16 months, which has been really good news. Yes, there are other rates to look at, but for the most commonly cited rate, it's good news. IBO is projecting, at least as of this moment, that robust job growth will continue in 2015 and 2016, and right now we're looking at gains of 83,000 for the current year and 80,000 for 2016. And that's taking the revisions we're expecting into account. Okay, so really good news on employment. Wages, not quite as good. Next page looks at average wages adjusted for inflation, and they've recovered far more slowly than employment. The first line looks at jobs in all sectors, and I've just put in some years, not all of them, but you can see, looking at the very top line, that average wages, after adjusting for inflation, are still somewhat shy of their peak in 2007. They did grow fairly strongly in 2014, but definitely shy of the peak, and that's largely because security sector, where the wages are so much higher, is still well short of what it was at the peak. Although the securities industry, in terms of average real wage growth, also had a reasonably good year last year. Most important, if you look at all other sectors, so everything other than securities, everything else regained average wages in 2011, so they came back to their peak levels. 12 and 13 weren't good years particularly, but in 2014 we've seen 3% growth. So we're finally beginning to see, putting securities industry aside, some real wage growth, and I think that's going to be very welcome in terms of the city economy strengthening. Moving on to the next page. Next two pages are a little bit harder to read, so I'm going to take a minute to just go over what these stacked bar charts show you. They look at employment and aggregate wage growth, not average wage growth, but total wage growth by industry. I've excluded a number of industries, not because they don't have large numbers of people in them necessarily, but because they didn't necessarily contribute much to growth over the last few years. So I'm focusing on what changed in terms of growth of both employment and wages. The industries that we're looking at are shown on the first column. It starts with professional and business services and goes down to information. The next two groups of bars show share of employment growth on the left and share of aggregate real wage growth on the right. And within each of them, on the first chart, you can see on the right-hand side the most current expansion, and on the left-hand side, the expansion before that. So easiest to do is take an example. Look at the first two sets of bars. You can see the professional and business services and education and health accounted for a very large share of total job growth in both the most recent expansion and the expansion before that. In contrast, if you go on to look at leisure and hospitality and trade, what we're seeing is a greater share of job growth attributable to leisure and hospitality and trade in the current recovery than we saw in the last one. And that makes sense, because if you think about how tourism has increased in the recent recovery, lots more people are coming into these fields, and it's been pointed out they're not particularly well-paying fields, but they've definitely been bolstered by tourism, and more job growth has been attributable to these industries this recovery than to last. It's also worth taking a look at the securities industry, it always is, and you can see that in the previous expansion, 9% of total job growth was attributable to securities, and in the most recent expansion, none of the job growth was attributable to securities because securities industry declined. That seems to be changing, and we expect that with the benchmark revisions coming out, we'll be seeing some positive numbers for last year. But in general, they haven't added jobs. And similarly, if you look at construction, very big role in the previous recovery and very little impact at all in the current one. The story changes somewhat if you look at the shares of aggregate real wage growth. And the most striking thing to look at is that purple bar midway down, that's the securities industry. And between 2003 and 2008, the securities industry alone, without the rest of the financial industry, was responsible for more than half of the total increase in wages and salaries during the expansion. That's amazing. If you put in the rest of the financial industry, it's over 60%. In contrast, for the most recent expansion, it's all of 11%. Huge change. I mean, it's still a significant percent because these jobs pay very well, but nothing like what we've seen in the past. I think it's also worth going down to the bottom bar and looking at information. With securities contributing less to wage growth, everybody else is contributing more to wage growth. And one of the industries that's now of a sufficient size to contribute more to wage growth is the information sector, which, like professional and business services, has a high component of tech jobs within it. So, we're seeing more of both employment growth and income growth attributable to tech. If you flip to the next chart, it's the same basic format as the other one, but this time around, what I'm doing is comparing the most recent expansion on the left side of each bar to our forecast, which is on the right side of each bar. And here again, professional and business services, education and health are still by far the biggest contributors to employment growth. But we're expecting that the share of employment growth due to leisure and hospitality and to trade is going to decline from what it did. So in our forecast, leisure and hospitality is expected to contribute 16% of all employment growth over the next 2 years, trade 11%, and those numbers are down considerably from what we had seen throughout the rest of the expansion. That's because we're expecting the strong dollar to have an impact on tourism in a couple of different ways, certainly discouraging more European tourists from coming here, but at the same time perhaps encouraging more domestic tourists who would have otherwise come to New York City to decide to go to London or Barcelona instead. Why they would want to do that is unclear to me, but expect it to happen. Securities industry, we're finally expecting them to resume hiring, but not by a lot, and small impacts from the other sectors. Once again, going to the right and looking at shares of aggregate wage growth, this is a very different securities industry than we've seen in the past. We're still expecting the securities industry to have a significant contribution to total wage growth, but it's going to be more on the order of 9% as opposed to 50%, which is what we've seen in some past expansions. Okay, taking a closer look at Wall Street, and I can tell you what's happened, although I don't necessarily have good answers for why it's happened this way. What you're looking at in the top part of the chart is revenues and expenses. Revenues are in blue, expenses are in red. And I should note that these are all for New York Stock Exchange member firms, which is just a subset of the securities industry, but acts as a good bellwether for what the rest of the industry is doing. Looking first at revenues, the blue bars, you can see that revenues are about half of what they were at the peak, which is definitely not good news. We've been assuming, although we have no proof for any of this, that tighter regulations and especially limits on proprietary trading are in part responsible, but we don't have firm answers on that. But fortunately for the industry, you can see that expenses have been almost commensurately lower in recent years. That's because interest costs have been so low. Now, obviously, that's going to change. And when it changes, what happens here is an open question. So the difference between revenues and expenses is, of course, profits, and you can see those charted in the bottom part of the graph. And you can see the profits have been in this $15 billion range for New York Stock Exchange member firms for the last couple of years. We're expecting it to stay in that range for this year. We don't have the last quarter yet, and for next year. But I think there's a real question of whether, as interest rates inevitably rise, whether the securities industry will find new revenue sources to increase commensurately and to keep profits at that level. So there's some real downside risk here. Okay, moving on to real estate. I start with commercial real estate. And commercial real estate, for those of you who recall what happened, the market for commercial real estate effectively collapsed in the midst of the financial crisis and the subsequent recession. The orange bars in the chart are commercial sales in billions of dollars. They plunged from $74 billion in 2007 to a low of $15 billion in 2009. And somehow they've managed to come up to $64 billion, the second highest level in 2014. That's an estimate. That's an extraordinary bounce back. I think many of us would have argued that the $74 billion level was unsustainable, and that there was a bubble involved here. It's harder to say it's unsustainable if it's happening again, so we'll see what occurs there. But at this point, at least, there doesn't seem to be any waning of interest in the sale of commercial buildings, particularly in Manhattan. The number of sales, the number of commercial transactions for very large transactions, which are buildings over 100 million, is charted in the blue line. So you can see clearly that the dollars are being driven by these very large commercial transactions. There were a little over 100 of them, we estimate, in 2014. We certainly didn't expect to see anything like that again, and here it is. And that's a huge risk to the forecast as well. Moving on to residential, not nearly as exciting. If you look to the right where the charts are, the first chart is just Manhattan. The top part of the chart shows median sales prices for Manhattan co-ops and condos. There aren't enough single-family homes in Manhattan to allow us to do the repeat sales index. On the bottom, you have sales volume, again, for Manhattan co-ops and condos. The real action is in the condos. And yes, they declined after the downturn, but then in the last couple of years have skyrocketed. That sharp increase has been due to the very top end of the market and has been dominated by this luxury development. If you look to the bottom part of the chart, which shows sales volume, condos are in the same blue. And you can see the volume is, there were relatively few sales, and that was because there were relatively few of these high-end condos coming onto the market, which is part of what induced the frenzy that we saw. I think there are a lot of other things going on, particularly international, that have fueled it as well. But it seems likely that with more high-end condos scheduled to come online in the next few years, that we may not see the same sharp increases in price of condos as we've seen over the last two. Things have been way calmer in the co-op market. I have a co-op. It's appreciated in value somewhat, not a whole lot. And if you look at the volume of sales down onto the bottom part of the chart, you'll see that the volume is actually still significantly below the 2004 peak. Some of that has been substitution between people who would have bought co-ops now buying condos. But some of it is the fact that this is largely a resale market and it hasn't been nearly as frenzied. Looking at the outer boroughs, which I don't often look at, but is really important. There aren't that many co-ops and condos out there, but there are a lot of 1, 2, and 3 family homes, many more than there are co-ops and condos in Manhattan. And if you look just at prices, you think things are pretty good. Prices have been for 1, 2, and 3 family homes have been rising, relatively slowly, but rising, but they still remain about 8% below the peak. Okay, but then you get a really different story when you look at sales volume. And if you look at 1, 2, 3 family home sales volumes, sales volume is about 1/2 of what it was in the peak, which was again about 2004. So that market really has not bounced back. And that's a real issue for the many more New Yorkers who are in the outer boroughs rather than in Manhattan. Let me just finish by saying something about risks. I agree that there are both downside risk and upside potential. I would put securities into both categories. The downside risk is as interest rates rise, they've got to find ways to bolster revenues in order to keep profits at even the okay levels they've been over the last few years. But I would never count the securities industry out. I've been at this long enough to know that we've counted them out many times, and somehow they always manage to bounce back. And I would not bet against them this time. Other downside risk, obviously tourism, to the extent the stronger dollar leads to fewer foreign tourists and more U.S. domestic tourists choosing to go elsewhere. And I think another major downside risk is whether the Fed will successfully engineer a soft landing. And I don't think we can assume that that's a given. In terms of upside potential, GDP growth we think could genuinely be higher than what the consensus is at the moment. Could be lower, but could be higher as well. And we have based upon the numbers we expect to come out next week, we definitely undershot on our employment forecast. And it's entirely possible we will do so again. So I think the risks are pretty much balanced. But the forecast for the city, given the positive forecast for the U.S., looks pretty good going ahead. Thank you.
Thank you, Ronnie. Any questions?
Yeah.
It sounds like a pretty upbeat report for the city of New York. Can I translate that into the conclusion that you need less state aid than you've got?
As a New Yorker, a New York Cityer, I would never say that.
Nice try, though.
Yeah, good try.
Okay, anything else? Okay, well, I want to thank all our presenters today. I've been told this is our 20th consensus conference. Let's hope it's another successful one. We look forward to working with you all over the next few days to come up with the consensus number, and thank you for your expert opinions.
Ditto.
Have a nice evening, everyone.